Okay, let's move on to step one. So first we have to identify the contract with a customer. And the first thing you're looking at here is, well, what is a customer contract? Well, a customer contract is an arrangement where there are legally enforceable obligations, rights and obligations between two or more parties. So that doesn't necessarily have to be a written contract between a vendor and a customer. Could be a verbal arrangement, an implied arrangement. Obviously, it's much easier to evidence that there's, legal enforceability when you have a written contract, but you're not limited to that from a standpoint of determining whether a customer contract exists. Also, if you think about today's guidance, there's a notion that you have to have persuasive evidence of an arrangement before recognizing revenue. Persuasive evidence of an arrangement is based on the typical way that a company does business. So if a company always gets a contract and they say we don't have persuasive evidence until both parties sign, well then you can't recognize revenue until both parties sign that arrangement. Whereas under this guidance, it's based on the notion of legal enforceability. So you may have a situation where even though both parties haven't signed, they may be legally enforceable. So you might have a situation where you have a contract with a customer under the new guidance prior to when you would have persuasive evidence under today's guidance. So that could, in some cases, result in earlier recognition. Now, when you're evaluating legal enforceability of an arrangement, one thing you're looking at is, what are the termination provisions in a contract? So if you had a situation where either party could cancel a contract at any point in time without any termination penalty, there are no legally enforceable rights and obligations. If either party can get out of the contract, nothing is enforceable if there's no termination penalty. So in that case, if a company can cancel, either party can cancel right away, you don't have a contract to account for at that point. If we switch that up a little bit, let's say you have an arrangement for multiple years, and the first year, both the customer and the vendor are locked in, so they can't cancel. But in year 2 or year 3, they're allowed to terminate without a penalty. Under today's guidance, you would look at that generally as a 3-year arrangement. Under the new guidance, what you'd say is, well, you're evaluating the legal enforceability. And so in that arrangement, the only portion that's legally enforceable is year 1. Either party can cancel in year 2 or year 3. So therefore, you would only account for that arrangement as a 1-year contract. You'd look at year 2 and 3, no different than you would a situation where a company has an option to renew in year 2 or 3. So you'd look at it as a 1-year contract, essentially with 2 years of options. Now you may have to, those options may be what are considered material rights that have to be accounted for, but you wouldn't say I have a full 3-year contract in that situation. And that could have an impact on a number of areas, particularly when you have multiple performance obligations. It might impact the amount of the total transaction price allocated to each performance obligation, which, as we'll see as we go through the model, will impact the amount that is recognized as revenue. Now, when we're talking about contracts with customers, it's not necessarily each individual contract that has to be accounted for separately. If there are situations where contracts are entered into, multiple contracts are entered into at or near the same time, those will be may need to be accounted for together. And what the guidance says is, well, you may have to combine those contracts and account for them together if any of the 3 criteria we have listed here are met. So I think that today's guidance actually has a rebuttable presumption when you sign contracts at or near the same time that they should be accounted for as a package unless that presumption is overcome. This guidance is not as strict, but I think in many cases it will result in the same thing or the same accounting, because if you think about these criteria, the first one is that were the contracts negotiated as a package and share the same commercial objective. In most cases, when you have 2 parties negotiating multiple contracts, it will be hard to argue that those multiple contracts were not negotiated as a package if they're signed at or near the same time. So I think in many cases, the result's going to be accounting for them as a package. Now, what's going to be judgmental, and is judgmental today, is what's meant by contracts signed at or near the same time. There's no bright lines on that, so companies will have to kind of make that evaluation of what sort of time frame they'd look to that's considered at or near the same time. So that's going to vary based on companies' particular facts and circumstances. There is also a practical expedient, and you'll see as we talk through the presentation today, there are quite a few practical expedients and policy elections included in the guidance, and a lot of these are included to be helpful from an implementation standpoint to make it a little bit easier. In general, it's not going to be very easy, but some of these practical expedients and policy elections will help that. And this practical expedient says that, well, if you have a number of different contracts that are similar types of contracts, you may be able to put them all together. So these aren't ones signed at or any at the same time. These are just contracts in general. Let's say you have thousands of homogeneous contracts. Guidance says, well, as a practical expedient, you can account for them as a portfolio if it's not expected to result in a materially different outcome. So the issue here as well, to evaluate whether something's not going to result in a materially different outcome, the question is, do I have to account for it separately and see if it would be different? And that wasn't the board's intention, so this is more of a qualitative evaluation to see if accounting for them together won't result in a materially different outcome. But that is something that will be, companies will have to support. Okay, so just because you have an arrangement with legally enforceable rights and obligations doesn't necessarily mean that you are past step one. So you have to meet these 5 contract existence criteria to actually move past step one into the rest of the model. So a number of these, I think, in many cases will be straightforward when you have an arrangement with legally enforceable rights and obligations. So looking at, does commercial substance exist? So is it not essentially a sham transaction? You have to look closer at situations where there are related party arrangements to make sure there is some substance and there's an expectation that cash flows will change. Approvals have been obtained, and there's a commitment on the part of both parties. So have to make sure that this is not a situation where you're typically, well, maybe you have a signed contract. You have a lot of if you have a lot of situations where companies back out of those arrangements, and you don't follow up with them on that, or your customers back out. You have to make sure that that's not the case, and there is a commitment to perform. Rights and payment terms are identifiable, so it's clear to both parties what their rights and payment terms are. And then finally, collection of the amount to which the entity will be entitled is probable. We'll talk about collection a little more on the next slide, but the way collection is evaluated is a little bit different under the new guidance in that it's really kind of a gating question under the new guidance. You have to support that collection is probable to even move throughout the rest of the model. Whereas today, it's more when you're evaluating collection, it's more of a measurement issue, I would say. Now, if you meet all these criteria, you generally don't have to reevaluate them going forward. So let's say you're performing under a contract, you don't have to continuously look at these 5 criteria to make sure they're still met. But if there is a significant change in circumstances, you do have to reevaluate them. So let's say there's a situation where you met all the 5 criteria and you're performing under a multi-year contract, and then 6 months into the contract, the customer has some significant financial problems, and you think that maybe collection's no longer probable. So in that situation, you would have to reevaluate that. And if you concluded that, well, now collection is no longer probable, it wouldn't have any impact on the revenue you've already recognized, but what it would impact is going forward. You would say, well, I'm no longer under the model, so unless I meet certain criteria, I can't recognize any revenue in the future. Also, you would have to evaluate any contract asset or receivable that you recorded as a result of your initial accounting for this contract. So let's talk a little bit about collectability, and there's some kind of nuances here when we're talking about collectability. So what you're looking at is it probable that the customer is going to pay substantially all of the consideration you'll be entitled to for the promised goods or services you're going to transfer to the customer. So you don't have to look at whether you're going to collect. It doesn't have to be probable you're going to collect 100% of the amounts. It just has to be probable you're going to collect substantially all. And again, no bright lines there, but certainly as you're in the higher 90s of expectation of what you'll collect, that's likely to meet the substantially all criteria. The other thing to think about here is, well, you're looking at the promised goods or services that will be transferred. And I think where the kind of the nuance here is that the promised goods or services that will be transferred aren't necessarily all of the promised goods or services in the contract. And so we'll walk through an example of where you may have a situation where you're not going to be evaluating the entire transaction price for a particular contract and determining if it's collectible. You might be evaluating less than that amount, which would be a difference from today, where when you're evaluating collectability, you're always evaluating the full price in the arrangement. Now, this is going to involve judgment in some cases, and the reason for that is, as you'll see when we get to step 3 on transaction price, step 3 considers a notion of implied price concessions. So there can be difficulty of evaluating whether you have a situation where you don't collect, whether that's considered an implied price concession that reduces transaction price, or if it's considered bad debt. And the impact of that would be, if it's collectability issue and bad debt, you record that as bad debt expense, whereas if you have an implied concession, that's actually recorded as a reduction of your transaction price, and which becomes a reduction of revenue. So your starting point for evaluating collectability is you look at your transaction price. And so even though transaction price is in step 3, you kind of have to peek ahead and evaluate that transaction price first as you're doing step 1. And transaction price, we'll go through this in detail later. It includes a number of different things, including your fixed cash consideration. It includes significant financing components. It also includes variable consideration. And so variable consideration might be any potential changes in the amount you expect to receive. So that could be through bonuses, it could be through penalties, it could be as a result of discounts. It could also be as a result of what I just mentioned earlier, implied concessions. And so a typical example that you might see on how you would look at an implied concession might be in the healthcare industry. So let's say you have a situation with a hospital and they're billing their patients, and even though the standard rate for a patient might be $10,000, they look at that and say, well, we're going to bill this patient who doesn't have insurance, they're self-pay, $10,000, but really we're only going to try to collect $3,000. So in that case, they wouldn't have a situation where they say, well, that $7,000 difference is bad debt. That would generally be considered an implied price concession. And so their transaction price wouldn't be $10,000, it would be $3,000. So from a collectability standpoint, you're starting off and you'd only evaluate that $3,000 for collectability, not the $10,000. And you can see how that would be a significant difference, because if they had to evaluate the $10,000, they likely wouldn't be able to say collection is probable. Whereas with the $3,000, there is a higher likelihood they'll be able to say that collection is probable. Now, when you're looking at collectability, though, you don't just stop there. It might be a lower amount you evaluate for collectability. And this is where the kind of notion of looking at the goods or services that will be transferred comes into play. And so an example of this might be, let's say you have a one-year contract, one-year service contract with a customer. You know that customer is not the most creditworthy customer, so you're mitigating your credit risk as a vendor. So what you're doing is you say, okay, I will provide you, customer, 1 year of services. However, I need you to pay me for the first 2 months up front, and then I'm not going to perform until you make those payments. And then in months 3 through 12, at the beginning of each month, prior to doing the service, I need you to pay me up front. So this vendor has mitigated their credit risk. There's no way they're going to provide some services without getting paid for those services before they provide them. So in this case, even though the transaction price will be based on 12 months of services, and that 12-month price, when you're evaluating the amount that's probable of collection, you're only going to look at the amount that relates to the goods or services that will be transferred. And you only know the goods and services that will be transferred are those first 2 months, because you've been paid up front. If you don't get paid at the beginning of month 3, you're not going to continue performing your services in month 3. So in this case, you're only evaluating 2/12, so 2 months out of 12 for collectability, not the full 12 months, because you know you're going to stop performing those services after month 2 if you're not paid. So in that situation, you're going to say, well, of course, collection is probable because I've collected up front, and so I meet the collectability criteria. Whereas if you had to evaluate the full 12 months, given this customer is not the most creditworthy, you wouldn't have been able to conclude that you meet this step 1 criteria. So if you meet the step 1 criteria, you move on to to step 2 and the rest of the model that we'll discuss. If you don't meet the criteria, then the question becomes, well, what do I do if I get some upfront payment? What do I do with that payment if I don't meet step 1? Well, initially what you have to do is you have to record a liability for that payment. And you would continue to evaluate whether you, as you go forward, whether you meet that step 1 criteria. If you do, then you could start applying the rest of the model. If you don't, so you don't continue not meeting that step 1 criteria, there's only a couple of circumstances in which you can actually take that liability, even if it's non-refundable, and actually recognize it as revenue before meeting the step 1 criteria. And so you'll have some differences from today, because today what you'll do if you get non-refundable cash and you've performed on part of an arrangement that relates to that cash, you can generally recognize that revenue, even if you're continuing to perform other services for that customer, because it's non-refundable and you performed. Under the new guidance, there are one of three criteria that have to be, one of 3 events, I should say, that have to be met to recognize that non-refundable cash. So you might have a situation under the new guidance where you're including an amount as a liability and not recognizing it as revenue for longer than you do under today's guidance. So here are the 3 events that, if they occur, you can recognize that non-refundable cash even though you haven't passed step 1. So the first one says that, well, if I've received non-refundable cash and there's no performance obligations, I've performed on everything I have to, and I've collected substantially all the amounts promised, then I can recognize it. Well, that one's not all that helpful, because that's basically the end of the contract, right? So it would be, if you couldn't recognize it, then it would be even harsher, because there's nothing left to be done. The second one would be if the contract's been terminated. And there are questions after the guidance was initially written or published, what do you mean by termination? Is that legal termination? Is that a situation where, what if I continue to try to collect? Is it not considered terminated then? So because of those questions, the FASB decided to add a third event subsequent to the initial issuance of ASU 2014-09. So this third event, which says, okay, if you have non-refundable cash, you transfer the related goods or services that cash, that consideration relates to, and you're not going to transfer any goods or services in the future and aren't obligated to, you could recognize that non-refundable cash. And so this is still stricter than today's guidance, because under today's guidance, if you got the non-refundable cash and you perform relating to that, even if you have additional goods and services you're going to transfer, you could still recognize that non-refundable cash as revenue. Under this new guidance, if you're continuing to perform, even though you've gotten non-refundable cash and performed on the amounts for the goods and services relating to that cash, you would still have to defer that as a liability until you do not have any future goods and services that you're going to transfer. So that's why I said earlier you may have situations under the new guidance that you have to defer that non-refundable cash longer than you do today. Okay, last item before we move on to step 2 is on contract modifications. And the good thing about this new model is the new guidance, or one of the good things, is that there is a model for contract modifications. Today, there's really no model for contract modifications and how to account for them, except under certain guidance like the contract accounting guidance. So today, there are always questions of, well, if I change a contract, do I apply that on a retrospective basis, or do a cumulative catch-up and adjust revenue today, or do I just account for it prospectively? And so there's a number of situations that the model for modifications addresses. We're not going to get through them in any detail, but the impact, there's a couple of things that will impact your conclusion here. One was were those changes approved? So do you have something that meets the definition of a contract when you have that modification? You're going to look at the pricing. So was it priced, there are new goods and services added? Was the pricing at its standalone selling price or not? You're going to look at the new goods or services that are added. Are they considered distinct from the goods or services you had in the old contract? And we'll talk about whether goods and services are distinct in step 2, but that'll have a significant impact. And so ultimately there can be, depending on the facts and circumstances, there can be 3 different results. One, you might account for the modification just as a separate contract. So this would be the case if you added some goods or services that were considered distinct and your pricing is at its normal standalone selling price. So that would just be prospective treatment as a separate contract. Another scenario might be you have to account for the arrangement as or the modification essentially as terminating the old contract and entering into a new contract. So that situation might be when you add some goods or services, but you don't price them at their standalone selling price. So that would still be prospective treatment, but the difference from the accounting for as a separate contract would be you're going to take your remaining performance obligations from the original contract, add it to the new goods and services or performance obligations, and reallocate your total fee or your total transaction price. The last bucket that you could fall into is that you do a cumulative catch-up adjustment. So if you have a situation where you add some goods and services and they're not distinct, what you would do in that situation is you just account for the modification on a cumulative catch-up basis. So you'd say, well, how much revenue did I recognize to date? How much would I have recognized had this modification existed on day one? The difference between those two would be an adjustment to your revenue at the point in time when the contract modification is approved. So I think it will be helpful to have an actual model under the new guidance compared to today where there really is no model.